What's up everyone? Every day we'll break down and analyze a different stock. So if this is something that interests you, subscribe to this channel. Also, remember to smash that like button, and if you have stock suggestions, please comment about it below. Today we're going to talk about Alibaba. When it comes to Alibaba, big data is everything. Omni-channel retail, cloud computing, media and entertainment, and online to offline services are all areas they focus on with the help of marketplace and logistics data. We believe that large e-commerce companies like Alibaba can expand into new markets because of strong network effects. 953 million people use Alibaba every year. Mobile marketing and content strategies that increase reach, click-through rates, and return on investment are now possible thanks to the wealth of data provided by Alibaba to retailers and consumer brands. However, for Alibaba's marketplace, lower monetization rates imply less money is being made. AliCloud and globalization hold significant long-term potential, while we believe Taobao and Tmall are Alibaba's main cash flow generators. Despite AliCloud's investment in the short term, the rise in revenue per user indicates that the company will focus on higher margin content delivery and database services. In the long term, third-party merchants can reach Lazada customers in Southeast Asia with more personalized mobile marketing and content options. ELE.me's management has convinced us that Alibaba users will bring in more revenue. Compared to Pinduoduo and JD, Alibaba users spend 770 yuan a month, while JD users spend 461 yuan a month. Alibaba's China retail marketplaces recorded a 90% annual retention rate for the fiscal year that ended in September 2021. In September 2021, Alibaba's core commerce had a non-GAAP EBIT margin of 26.2%. JD Retail's 2.3% and PDD's 15.2% were both beaten by this. According to Bears, the expansion of other e-commerce firms might stifle Alibaba's. With 867 million active buyers in 2021, Pinduoduo had a larger customer base than Alibaba. It is also uncertain when Alibaba will become profitable in its expansion into non-physical goods businesses and new markets. Internet giants such as Douyin and Tencent can also enter the e-commerce market as well. For example, Douyin sells more clothing and beauty products than Alibaba. As more merchants join the platform, we can maintain a wide economic moat thanks to Alibaba's strong network effect. The network effect is a win-win situation for all Chinese e-commerce platforms. We do not believe that Pinduoduo, Douyin, and Kuaishou can sustain long-term profitability in the physical goods e-commerce market. More than a decade of profitability at Alibaba is expected to continue for at least another 2 decades. In the long run, Alibaba will still have a significant market share if new competitors succeed. Thus, it has a large customer base, a wide variety of stock-keeping units, and various tools to help merchants manage their businesses. For example, the world's largest e-commerce platform can predict how much money merchants will make and how many products they will sell, allowing them to plan accordingly. Its core annual active customers aged 25 to 44, who account for 70% of gross merchandise volume, have remained loyal in the face of fierce competition. As a result, Alibaba has a stranglehold in the world of online retail. The Chinese retail market is extremely complex, and we believe Alibaba will always have a place in it. A return on invested capital is lower than PDD and JD Retail's, but not enough to keep Alibaba's lower than PDD and JD Retail's in the next 5 years. According to our estimates, JD.com's first-party platform can fetch better prices, and the company's third-party platforms can bring in more revenue. Although Alibaba's first-party supermarket business, which generates roughly the same revenue as JD's, is expected to expand. Consequently, the company will only see non-GAAP profits in the future. Sales and marketing took precedence over R&D for the first 5 years of the company's existence. Short-term profitability may not be possible for PDD, but long-term success is our goal. Gaming and e-commerce are 2 areas where ByteDance competes with other internet firms. Although ByteDance will lose $2.1 billion in 2020 and $684 million in 2019, it will still be profitable. It's also unclear if ByteDance's e-commerce venture will be a moneymaker. Douyin and Kuaishou have made progress, but Alibaba and JD will not be overtaken in the next 20 years. Selling content like short videos or live streaming, or products that people want, is how these newer platforms make money on these newer platforms. Kuaishou and Douyin's GMV is only 16 and 30% of their respective platforms' GMV, respectively. The rest is taken care of by third-party platforms like Alibaba and JD. Douyin's goal is to build an e-commerce platform that does not send traffic to competitors. Customer service e-commerce platform governance that balances the interests of merchants and customers, supply chain, logistics, and merchant support are all essential to a successful online business. People who watch live streaming are more likely to buy things quickly, so the return rate should be higher. For well-known brands, it's difficult to plan production volumes and achieve economies of scale when sales are uncertain. Thus, these businesses would no longer be reliant on content e-commerce firms alone for their online sales. Instead, China's venture capitalists support promoting new brands via short-form video platforms to garner interest and facilitate the sale of their goods. These brands may be able to maintain their GMV without advertising on these platforms, but it's not clear yet. Creating a third-party e-commerce platform that recommends products to customers while saving them money may be beyond the capabilities of Douyin. Increasing the number of people using Douyin to search for products will hurt Alibaba even more. But we don't think we can because it takes a lot of work to build a successful e-commerce business. While JD began working on its 3P platform in 2010 and has yet to compete with Alibaba in 3P sales, the company has made significant progress in the area. The environmental, social, and governance risks associated with Alibaba's exclusive agreements with merchants are substantial. However, because exclusive merchants can no longer sell on Alibaba, we doubt this will significantly impact Alibaba's wide moat. Because of this, we estimate that their share of total GMV is very small. Fiscal 2022 revenue growth is expected to be 10% compared to the company's forecast of 20% to 23%. As a result, investments in Taobao deals and Lazada, as well as efforts to retain merchants, will reduce adjusted EBITDA margins. Consequently, companies will outpace third parties in the years ahead. From fiscal 2021 to 2026, we expect a 15% annual revenue growth rate. As more people shop online, more users and sellers emerge, and as a result, Alibaba's e-commerce business becomes more profitable, we believe. This is what we've come to expect from the situation. Consumer spending in China is expected to rise 10% in the next 5 years, thanks to mobile monetization opportunities such as idle fish and short-form video feeds like Taobao Live and Weibo. dApps are expected to grow at a 15% annual rate, while cloud computing is expected to grow at a 23% annual rate. There are many areas in which we believe Alibaba will be able to make significant progress in the near future. Investments in Taobao deals, the community marketplace, Lazada merchant retention, technology, logistics, product development, online/offline and local services, and marketing should help reduce some of the margins currently being enjoyed by our competitors. We expect this to happen. As a result, non-GAAP adjusted EBITDA margins will fall to 13.1% in 2027 from 23.8% in 2021 as a result. However, as Alibaba's investments mature and its newer businesses grow, we expect margins to stabilize. Because of this, our fiscal 2031 EBITDA margin estimates remain unchanged at 15%. Pinduoduo demonstrated that the Chinese e-commerce market has become more competitive with its superior services to Alibaba and JD.com. Online retailers like Vine and Tencent have made their presence known in this sector. This means, by the end of 2020, the number of active customers will be greater on Pinduoduo than it will be on Alibaba. This is the most important issue for Alibaba in terms of the environment, society, and governance. Chinese authorities imposed a fine of 18.2 billion yuan on the company in April 2021 for compelled use of its platform. Other people were also warned not to treat it unfairly. Regulators in China's financial sector were so worried about online financial services that they canceled the company's initial public offering. The problem of counterfeit and piracy on Alibaba's marketplaces has long been addressed. Alibaba's value has not decreased, but the Hangzhou government's choice of sending representatives has sparked concerns. Managers may be distracted, and Alibaba's expansion into non-core businesses may reduce profits. Nevertheless, we believe Alibaba can assist foreign retailers and consumer brands in locating a Chinese counterpart in China. Network effect and brand recognition aren't as strong in other countries, making it more difficult to enter on your own. Issuing stock to shareholders makes sense when a company's financial position is sound. From 260 billion yuan in fiscal 2019, Alibaba's cash reserves rose to 325 billion yuan at the end of March 2021. Unlike Amazon and JD.com, these companies don't pay out dividends to shareholders. The answer is no, Alibaba isn't one of those companies. Small dividends are paid out by Tencent, a Chinese internet giant that's similar to Google in size. The majority of financially successful Chinese internet companies do not distribute profits to shareholders in the form of dividends. Expanding and investing in new businesses is a strong suit for Chinese internet companies. Return on invested capital decreased from 52% in 2017 to 23% in 2021 for Alibaba. This is because the company decided to invest heavily in new ventures rather than focusing on making money now. As a result, its return on capital, ROC, dropped from 26% in 2016 to 15% in 2020. We believe so because Alibaba's ecosystem has grown tremendously. At an average price of $218 per ADS, Alibaba repurchased approximately 1.7 million ADSs, or about 13.6 million ordinary shares. This is below what we estimated the fair market value to be. Additionally, the cost of Alibaba's share repurchase program rose. In the end, it will last until 2022. Because the stock is still low, we're in favor of the initiative. We think management has done an excellent job investing in e-commerce, cloud computing, and logistics. Alibaba, for example, has invested in the best logistics companies and Cainiao to improve e-commerce delivery quality. According to IDC, China's public cloud services market will grow to 41.6% by 2020. As a matter of fact, it was ahead of its main rival Tencent in the early 2009 period. The money we're investing now will pay off in the long run if we want to remain a major retailer while also helping businesses make the most of technology. We expect Alibaba's adjusted EBITDA margin to be lower than it has been in the past because of the profitability of its Chinese e-commerce peers. These two areas have been prioritized for initial investment. Those who live in developing countries and want to purchase services online are the target audience. Supply chain efficiency and merchandising in high-frequency categories will benefit from these investments. Management's goal of having more than 100 million active customers in China by the end of 2021 is something we applaud. There are many benefits to investing in the company, including this. Alibaba will benefit from the wide moat network effect. Thanks for listening, everybody. If you enjoyed this video, smash that like button and remember to subscribe. Until next time.